All right, everyone, welcome. Today, we're going to dive into a concept that, I promise you, is absolutely foundational to being a smart business leader: operating cash flow. You're going to learn about all sorts of complex financial tools in your career, but trust me, getting a deep, intuitive feel for this one metric, well, that's what separates the good managers from the great ones. It's the key to really understanding a business's health and avoiding some of the most common and most devastating financial traps.
So let's kick things off with the real head-scratcher, a question that has been the downfall of countless companies. Is it possible for a company that is, on paper, reporting fantastic profits, we're talking millions, to suddenly find itself completely out of cash and unable to pay its bills? Can a profitable company actually go bankrupt? And the answer, which a lot of people have learned the hard way, is a resounding, unequivocal yes. Our job today is to figure out how on earth that can happen.
So, how do we solve this puzzle? Well, the answer lies in looking beyond the income statement and really getting to grips with something called accrual accounting. Now, the income statement is great for seeing if a company is profitable, right? But here's the catch. It recognizes revenue when it's earned, not when the cash actually hits the bank account. So you could deliver a huge order to a customer, book that as a massive sale, and show a big profit, even if that customer isn't going to pay you for another 90 days. The same goes for expenses. They're recorded when you incur them, not when you write the check. This gap, this timing difference between the idea of profit and the reality of cash, is where all the trouble starts. And that is where the statement of cash flows comes in. This is the document that tells the true story. If you think of the income statement as a report card on profitability, think of the cash flow statement as a heart monitor, tracking the company's lifeblood, its actual real spendable cash. This statement doesn't care about when a sale was supposed to happen, it only cares about one thing: did cash come in or did cash go out? It gives us the clearest picture of a company's liquidity, its ability to actually pay its employees, its suppliers, and keep the lights on day in and day out.
Now, when you look at a cash flow statement, you'll see it's broken down into three parts: cash from operating, investing, and financing activities. Investing is about buying or selling big assets, like buildings or equipment. Financing is about how you raise money, maybe from a bank loan or by issuing stock. Both are important, for sure, but if you want to know if the core business itself is healthy, you look right at the first section: operating activities. This is the engine room. This tells you if the company's main business, what it actually does every day, is generating cash.
So what does that actually mean? Principal, day-to-day, revenue-producing activities. It's simpler than it sounds. If you're a car company, it's the cash you get from selling cars. If you're a consulting firm, it's the cash you get from your clients' fees. It's the money that comes directly from your primary business model. It's crucial to separate this from other cash sources. For instance, if that car company sells an old factory, the cash from that sale is an investing activity. If it takes out a big loan, that's a financing activity. Operating cash flow isolates the pure cash-generating power of what the company is actually in business to do.
The easiest way to think about this is to picture an old-school balancing scale. On one side, you pile up all the cash coming in, primarily from your customers buying your stuff. On the other side, you put all the cash going out, just to run the business, paying your suppliers for materials, paying your employees' salaries, paying the rent, the utility bills, the whole shebang. A fundamentally healthy business is one where that inflow side is consistently heavier than the outflow side. It's as simple and as critical as that.
Okay, so we've defined it, we know what goes into it, but the big question is, why do we care so much? Why is this one number so incredibly important for literally everyone? Managers, investors, lenders. Why is it such a vital sign of a company's health? This quote right here, it really gets to the heart of it. A business has to be able to generate enough cash from its own operations just to keep itself going. If you see a company with consistently negative operating cash flow, that is a massive red flag. It means their main business is actually burning through more cash than it's bringing in. And that, no matter what the income statement says about profits, is a recipe for disaster. It's just not sustainable.
Let's break down the power of having a strong, positive operating cash flow. First, and most importantly, it lets you maintain solvency. That's a fancy way of saying you can pay your bills when they're due. You can make payroll. You can keep the lights on. It's basic survival. Second, it allows you to fund your own growth. Want to develop a new product, open a new location? You can use the cash your business is already generating to do it. And that leads right to the third point. You can avoid external financing. When you can fund yourself, you don't have to go begging the bank for a loan or giving up ownership to investors. You stay in control. You call the shots. That is an incredibly powerful position to be in.
Okay, enough with the theory. Let's get our hands dirty and see how this works in the real world. I want you to put on your manager hats for a minute. We're going to walk through a very common decision, but we're going to look at it through the lens of operating cash flow. This is where the rubber really meets the road, where accounting concepts turn into smart business decisions.
So here's the deal. Your company's doing great. The income statement looks fantastic, profits are climbing, the leadership team is excited, and they want to make a strategic move, hire a brilliant top-tier software developer. This is a fantastic idea for the future, right? It's going to drive innovation and probably lead to even bigger profits down the road. But there's a catch. That new hire means a new significant monthly salary, an immediate cash payment that you have to make starting right now, this month.
Now, this is the moment of truth. Here's the classic mistake. A manager looks at the profit forecast and says, sure, future profits will more than cover it, let's hire them. But the savvy manager, the one who understands cash flow, asks a very different and much more important question. They ask, forget future profits for a second. Looking at the cash coming in from our customers right now, today, do we have enough of a surplus to cover this new salary every single month? The decision isn't based on what you hope to make, it's based on the cash you actually have.
So let's bring all of this home. If there is just one single idea you take away from our class today, I want it to be this one. It's a simple little analogy, but it's one that can literally save a company and make your career. And it's the difference between profit and pulse.
Let's really drill down on this analogy. Think of reported profit like your annual physical exam. It's important, right? It tells you about your overall health trends, your long-term prospects. But operating cash flow, that's the company's pulse. It's what a paramedic checks first. It tells you if the business is alive and breathing right now. A company can have a great physical exam report, high profits, but have no pulse, no cash flow. And we all know what that means. A strong, steady, positive operating cash flow tells you the organization is healthy, it's functioning, and it can survive today to thrive tomorrow. And that's the question I want to leave with you. As you move forward, whether you're managing a department, starting your own company, or investing your money, you're going to be looking at businesses and trying to figure out if they're healthy. Many people, they'll get distracted by the shiny big profit numbers. But the truly smart leader, the one who makes the right decisions, they know you always check the pulse first. Answering that question correctly will make all the difference in your career.